Good morning, everyone. In this presentation, we shall be discussing the accounting in the headlines for movie industry. My name is Pradyumna Pradhan, and this course, Financial and Accounting Skills for Managers, will we shall present on a movie. Today's date is November 4th, 2025, and here we go. So, first of all, we shall be discussing the case study overview, the economics of a blockbuster. The case subject of this presentation is the movie Marvel's Avengers Endgame, released in 2009. This movie is a high stake example for one of the highest grossing films in the history. Moreover, it also provides rich accounting complexities. The key financial elements in this movie are the initial production budget was $300 million. However, the global box office revenue was generated around $2 billion, and along with that, there were also a few contractual royalties and bonus payment for the actors in the movie. So the first transaction that we'll be discussing about is capitalizing film's production cost. The initial investment covered all necessary requirements needed to create the film, including the sets, principal photography, special effects, actor salary, etc. And these costs under globally accepted accounting principle are capitalized and treated as film production asset. Why asset, we might ask? Because these costs are expected to generate future revenues for the studio and are also therefore treated as an intangible asset until the revenue is collected back, matching the expenses to the period they benefit. The journal entry for this investment is debit for the production asset is $300 million, and credit cash is also $300 million. So the second transaction that we'll be discussing is recognizing box office revenue. There are different methods that we recognize the revenue. Firstly, by the ticket sales, where consumer purchase ticket globally, generating a gross revenue. And there's also the theater share, where the exhibition partner, they retain about 30 to 50% of the ticket sales. And there's also the studio shares, where the distributor collects the remaining portion of the net revenue. The journal entry for recognizing the studio's revenue share are assuming that the studio share of global box office revenue is $1 billion. In this entry, we can see debited cash is $1 billion, and credit in revenue is $1 billion. The third transaction that we shall be discussing is accounting for royalties and profit payments. Many of the major actors in this movie, including the directors, have contracts that pay them royalties, often based on the defined net profit or the gross revenue margin of the movie. These contractual payouts represent a significant post-release expenses, as you like the record this record the obligation to pay profit participants. These are also treated as selling generals and administrative expenses, matching the payout of the to the period of revenue generation, matching the principal amount. The exact definition of net profit is often a source of contention. The journal entry for this recording conceptual payouts are as follows, which is $50 million in royalty expenses and credit cash. So The critical analysis part, where the transparency challenge is seen as Hollywood accounting. The main issue that is in present in this scenario is understated profit. Like studios are often accused of manipulating internal cost allocation, like distribution fee, inflated overheads, etc., to minimize their reported net profit. The consequences are unfair payouts, like if the contractual net profit is zero or negative due to this allocation, participants receive minimal or no royalties at all, despite their massive box office hit. Now, how can we correct this? We can correct this by applying standard accounting principles like GAAP, which is strictly apply for revenue recognition and ensure timely and accurate reporting of studios' income. We can also use matching principles to ensure that the film's amortization and the other costs are systematically and rationally matched to the revenue they generate. And finally, transparent disclosure, where clear separation between gross receipts and distributors' cost and net revenue is eliminated to eliminate ambiguity in profit calculation. Following this, we shall be discussing financial statements of the film and film economics. Accurate accounting provides a comprehensive view of film's economic life cycle for investors and stakeholders as well as the actors in it. Firstly, it's equity, where retained earnings and investors' capital are affected by ultimate film profitability. The liabilities, which include contractual obligation like royalty accruals and production debts. And finally, the asset, where film production asset, that is cost cap, and cash, which is box office receipts. So, key lesson for ethical financial reporting that we can learn is transparency, where clear, understandable report of cost allocation, profit definitions, eliminate disputes, and build trust within creative partners. Matching principle, where revenue from ticket sales, licensing must be systematically matched to the cost of production and distribution. And ethical reporting, which is adhered to high ethical standard to ensure fair payouts, protect the integrity of financial statement and investors relations. Coming to the further concept of amortization challenges, the film production asset is amortized over time. This process is crucial and often subjective. The method are simple. The asset is amortized in proportion to the film's recognized revenue compared to its total anticipated lifetime revenue, which is the forecast. And if the forecast is optimistic, amortization is quite slow. It is low expense. And if the forecast is pessimistic, amortization is fast. So, talking about the conclusion, finally, accounting is as a storytelling. In the entertainment industry, accounting doesn't just track cost, it provides a financial narrative of a firm's economic success. The journal entries illustrate the flow of capital from asset to cash collection, that is revenue, to expenses. Financial clarity is required where statements must provide clarity on true economics of film production, separate from internal profit definition, and finally investors trust. Uh, Regular adherence to globally accepted accounting principle ensures investors trust ethical treatment of creative talents through accurate reporting. And with this, I'd like to thank you all for listening to my presentation. Here is my references for this particular presentation. Thank you very much.